Good day. As we approach the midpoint of the year, persistent inflation and elevated financial stability risks continue to mark a somewhat improved global growth outlook. South Africa's economic conditions, however, remain poor. Although growth prospects in Asia and Europe have improved, both regions remain negatively affected by Russia's war in the Ukraine and heightened geopolitical tensions. The United States continues to exhibit economic resilience, but also specific financial fragilities. More recent data suggests China's growth performance will remain relatively modest, with little benefit to commodity prices. In the developing world, many economies face high debt levels, weaker economic growth, and prolonged adverse financing conditions. While goods price inflation has eased in much of the world, core inflation continues to rise, keeping consumer price inflation from falling more sharply. We expect global financial markets to remain volatile and policy rates elevated. Taking these and other factors into account, the SARB's forecast for global growth in 2023 and 2024 is revised higher to 2.4% and 2.7% respectively. The April World Economic Outlook of the International Monetary Fund forecasts global growth at 2.8% and 3% for 2023 and 2024, respectively. For 2023, the bank's forecast for GDP growth is slightly higher at 0.3%. Energy and logistical constraints remain binding on South Africa's growth outlook, limiting economic activity and increasing costs. We estimate load shedding alone to deduct 2 percentage points from growth this year. Household spending is expected to grow very modestly in real terms, in line with a positive but weak rise in real disposable income. Investment by the private sector remains positive, in part reflecting efforts to overcome bottlenecks in energy and transport supply. Our GDP growth forecast for 2024 and 2025 is unchanged from the previous meeting at 1% and 1.1% respectively. Economic growth has been volatile for some time, and prospects for growth remain uncertain. An improvement in logistics and a sustained reduction in load shedding or increased energy supply from alternative sources would significantly raise growth. The rand's weakness provides some short-term benefit to the tradable sector. Conversely, alongside more modest global growth rates and a lower terms of trade, higher import prices and headline inflation create downside risks to growth. Overall, domestic and global prospects appear to be highly sensitive to new shocks. At present, we assess the risks to the medium-term domestic growth outlook to be balanced. Turning to inflation prospects, our current growth forecast leaves the output gap around zero over the next 3 years. This implies very modest positive pressures on inflation from the forecast growth rate. South Africa's external financing needs, however, are expected to rise. Despite broadly stable oil prices, import price inflation is higher. Falling export commodity prices and weaker growth in export volumes are expected to increase the current account deficit to 2.5% of GDP this year before expanding it further to 3.1% and 3.6% of GDP, respectively, in 2024 and 2025. With reduced tax revenue, higher public sector compensation and state-owned enterprise financial needs will put additional pressure on financing conditions for rand-denominated bonds. The risk premium charged on rand-denominated borrowing has increased sharply. 10-year bond yields reached a high of 13.78% on the 23rd of May and are currently trading at about 12.3% despite the expected moderation of inflation over the forecast period. The rand has weakened over the past year, with further sharp depreciation in recent weeks. The implied starting point for the rand forecast is 18.68 rand to the US dollar, compared with 17.80 rand at the time of the previous meeting. Currency markets are expected to remain volatile and sensitive to idiosyncratic shocks. At a global level, consumer price inflation in 2023 is forecast to be 7% compared to 8.7% in 2022. In the G3 economies, despite an easing in headline inflation, price pressures remain clearly evident in measures of core inflation, services, and wages. Our estimate for inflation in the G3 in 2023 is higher at 4.3% and is unchanged at 2.1% in 2024 and 2025, respectively. The rise in South Africa's headline inflation rate has been shaped primarily by fuel, electricity, and food price inflation. Compared to the previous meeting, fuel and electricity price inflation is somewhat lower and food price inflation higher. Fuel price inflation is expected to be -2% in 2023. The electricity price forecast is lower at 11.6% in 2023, 13.4% in 2024, and unchanged at 10.9% in 2025. Local food price inflation is revised up again, in part due to the lagged impact of the richer exchange rate. This is despite global food prices falling in dollar terms. Food price inflation is now expected to be 10.8% in 2023 and 5% in 2024. Our forecast for core inflation is revised up to 5.3% in 2023, 5% in 2024, and 4.6% in 2025. Services price inflation in 2023 is expected to come in at 4.9%, unchanged from the previous meeting. Core goods inflation, however, is higher for this year at 6.3%. Growth in average salaries and unit labor costs is higher in 2023 and 2024 and slightly lower in 2025. With core goods and food higher in the near term, headline inflation for 2023 is revised up to 6.2%. Headline inflation for 2024 also increases to 5.1% before moderating to 4.5% in 2025 on the back of easing food and fuel inflation. Risks to the inflation outlook are assessed to the upside. Despite easing of producer price and food inflation, global price inflation remains high. Global oil markets are expected to remain tight with upside risk to prices. Electricity prices and other administered prices continue to present short and medium-term risks. Domestic food price inflation continues to be elevated, and the risk of drier weather conditions in coming months has increased. Load shedding may additionally have broader price effects on the cost of doing business and the cost of living, in particular as diesel consumption increases. Given sticky petrol and food price inflation, considerable risk still attaches to the forecast for average salaries. Average interest rate levels in major economies are higher than were projected in March. Tighter global financial conditions raise the risk profiles of economies needing foreign capital, leading generally to weaker currencies. Given upside inflation risks, larger domestic and external financing needs, and load shedding, further currency weakness appears likely. Higher inflation outcomes have resulted in elevated inflation expectations. Expectations for inflation in 2023, based on market surveys, are 5.9%. Longer-term inflation expectations, derived from the 5-year break-even rates in the bond market, have sharply increased to about 6.5%. Headline inflation is forecast to remain above the upper end of the inflation target range until the third quarter of this year, and will only sustainably revert to the midpoint of the target range by the second quarter of 2025. The forecast takes into account the policy rate trajectory indicated by the bank's quarterly projection model. Against this backdrop, the MPC decided to increase the repurchase rate by 50 basis points to 8.25% per year with effect from the 26th of May 2023. The decision was unanimous. At the current repurchase rate level, policy is restrictive, consistent with elevated inflation and risks. The policy stance aims to anchor inflation expectations more firmly around the midpoint of the target band and to increase confidence of attaining the inflation target sustainably over time. Guiding inflation back towards the midpoint of the target band can reduce the economic costs of high inflation and achieve lower interest rates in the future. Reaching a prudent public debt level, increasing the supply of energy, moderating administered price inflation, and keeping wage growth in line with productivity gains would enhance the effectiveness of monetary policy and its transmission to the broader economy. As usual, the repo rate projection from the quarterly projection model remains a broad policy guide, changing from meeting to meeting in response to new data and risks. The economic and financial conditions are expected to remain more volatile for the foreseeable future. In this uncertain environment, monetary policy decisions will continue to be data dependent and sensitive to the balance of risks to the outlook. The MPC will seek to look through temporary price shocks and focus on potential second-round effects and the risks of de-anchoring inflation expectations. The bank will continue to closely monitor funding markets for stress. This concludes the MPC statement. And at this point, we would like to invite members of the media to pose questions. And as usual, identify yourself and the media house you represent, and then we will respond to your questions.
Good afternoon, Kopanogumbi from Reuters. My first question is, how long do you think that policy can remain restrictive in a way that is not going to hurt South Africans in the long term? And then secondly, the committee mentions that import price inflation and domestic food price inflation are higher. Would the bank consider using a tool other than interest rates to try and contain this? And my third question, if bond yields were to increase further, do you imagine a scenario where the bank would have to intervene? And then lastly, I know that the bank is loath to intervene directly in currencies, but with the kind of volatility we're seeing and the expectations for further currency weakness, could any interventions be warranted? Thank you.
Kopano, just your first question is, how long would policy remain restrictive, and how long would it bring? And then you talk something about long-term South Africans.
How long would it remain restrictive in a way that would not hurt South Africans even further?
In a way that will not hurt South Africans, yeah. Okay.
Governor Mpotla Kudi from Bloomberg News. And my question is, on what basis is the central bank not forecasting a contraction in GDP recession for this year, given that several private sector economists are forecasting a recession for this year?
How is the...
On what basis is the central bank not forecasting...
not forecasting.
A GDP contraction?
Got it.
Given that there are private sector economists who are forecasting a recession for this year?
Hilary Jaffe from Business Day. Governor, when last was the committee unanimous on a decision? And what was that decision? Is my first question. And a second question is, how do you explain such a large divergence in the food price inflation trend globally versus in South Africa? Globally, you've got very significant deflation. In South Africa, you've got very significant food price inflation. You mentioned the exchange rate as one of the factors. I wondered what your take was on other factors. Thanks.
Okay. Let's deal with those now. Kopano, how long will the policy be restrictive? We have just become restrictive. For some time, we had said that although we have been tightening policy, we hadn't reached restrictive territory. We have now reached restrictive territory. We have just reached restrictive territory. So how long it would be is state dependent rather than time dependent. What do I mean? There wouldn't be a relaxation of policy until the inflation trajectory changes and inflation moves towards the midpoint of the inflation target range on a forward-looking basis. In other words, policy gets calibrated in such a way that if we expect that inflation will be reaching the target by this time, it might be on a risk-adjusted basis possible to adjust policy. For now, we have just become restrictive, and we have got to see the effects of this policy stance and what it means. And you say, how do you keep it like that in such a way that you do not hurt South Africans in the long term? In the long term, South Africans will benefit from this tight stance because the stance will bring down inflation. And the cries of South Africans had been that inflation is eroding their incomes. And as we presented this statement, we talked about how modestly disposable incomes have been rising, and it is a function of inflation eroding the incomes of South Africans. Does it hurt? Yes, in the short term, it would hurt. But we have got to take the short-term pain in the interest of long-term gain. So a short answer to your question is that the hurt will be in the short term, but South Africans will benefit long-term, medium to long-term, as inflation declines because of the policy stance that had been taken. And you asked, prices are rising, other tools. No doubt that there are other tools, but the tools that are there are not within the control of a central bank. These tools lie elsewhere. If you have got concentrated markets, competition policy deals with that, and they have been very active in that space. If municipalities jack up municipal rates and taxes, inflation can be brought down if they decide that prices they set should be in line with the inflation target. That would help. And the same goes for the other price setters in the public sector. If the other price setters in the public sectors who set prices, everything from electricity to water tariffs and so forth, if all of them play ball and only adjust prices in line with the inflation target, that will help to bring inflation down. Absent all of those, the instrument that we have as the central bank is the policy rate, and that is what we will deploy to deal with inflation. Rise in bond yields and whether we would do anything. Well, you cannot hold a lid on a boiling pot forever. If bond yields rise as in response to changes in fundamentals, there is nothing you can do to bring those bond yields down unless you correct the fundamentals. And what we have seen has been that South African bond yields have been responding to a rise in the country risk premium. And the country risk premium is driven by a range of factors varying from the fiscal stance, fiscal developments, to political developments, and all of those. And if you are to then contain bond yields, you are going to have to bring down, you have to adjust and make sure that the fundamentals are actually in place. For a long time, we had been highlighting that elevated debt levels contribute to the risk premium, and because they contribute to the risk premium, they contribute to the rise in bond yields. It also fits itself into the volatility of the exchange rate of the rand, which then, with the rand depreciating as a result of all of this, begins to feed through into the price formation process. And that is what we would respond to. Naturally, what we would do is to say we will see through the shocks. But if this thing continues over a longer period of time, you can no longer see through it, because then that means it has become persistent and you have got to deal with the inflation, deterioration in the inflation outlook based on that. Intervention. We have paid very expensive school fees as South Africans in 1998. We intervened in the currency markets. Over a period of a week, we ramped up the net open forward position from $10 billion to $26 billion. And we still couldn't arrest the slide in the currency. So, I said it was very expensive school fees. If central bankers were to have a lesson in modesty, it would be that the exchange rate is not one of the factors they control. We can come into the foreign exchange market or the bond market to provide liquidity and make sure that there isn't market dysfunction. That's all we can do. We cannot stop the currency from depreciating. We cannot stop bond yields from rising. I'm going through this because I'm expecting that the panel here is looking at when was the last unanimous decision, and I'm sure they will find it. It should be at least 18 to 24 months, but somebody will find it. And Mpo, why are we not forecasting a contraction? Well, the private sector out there, none of them are forecasting a contraction. Their growth forecasts are modest. They will be 0.2, 0.3, others. There is no one who closer to 1. Everybody is below that. That does not mean a recession might not take place, because there is a technical definition of a recession. It's sort of like strange. In the US, there is the National Bureau of Economic Research are the authority that can pronounce whether the US economy is in recession or not. And that is it. That once they have pronounced, the economy is in recession. Elsewhere in the world, the definition is 2 consecutive quarters of economic contraction are a recession. That might take place, but we will still, as far as we are concerned, we will still grow by 0.3% this year. It's not in our baseline, but it is a risk that might take place, that you could have a recession. So even out there, they are forecasting low growth, but they have not talked of a recession. Part of it is also that people thought that the first quarter is going to be so bad, but the short-term indicators seems to suggest that we would still report a positive growth in the first quarter of this year. Hilary, the divergence of global inflation what is termed global inflation is some weighted average of the inflations of different countries. And the law of big numbers will tell us that there will be countries that have high inflation and others that have low inflation. And on average, you will then come up with some figure. But you're right. It's not just divergence, the dispersion in terms of the inflation rates, even in the advanced economies, by the way. For example, the UK inflation has just declined to just below 10. In the US, inflation had declined rapidly, it's now below 5. And you see this divergence all over. In our case, our inflation drivers had been mainly food and fuel. And then you can add administered prices, but food and fuel had been the big drivers. But what we have recently seen had been that these rises in prices have spread to core goods inflation. And you will see in the statement that we have revised core goods inflation to above 6. And so it is no longer that you can say that it's food and fuel, there is nothing you could do about that, because we have seen that this had spread to the other prices. Hence, policy had to be adjusted to deal with that. Have we found our unanimity?
We're not that often. We're not unanimous that often, but I think it's September 21. If I think I got Hillary's question correctly, it was about the divergence in food inflation. Am I right? Not inflation.
Oh, okay. Since you volunteered, can you deal with the food inflation?
So it is true that the FAO, the World Food Organization index, has declined, and globally grain prices have come down. But actually food inflation is sticky in a number of countries. I won't go to Venezuela, but sort of UK food, this is March, not April, but March figures. UK 19.1, Czech Republic 17.3, Sweden 17, Germany 16.8, Euro area 16.4, Netherlands 15.6, France 14.9, South Africa 14, Spain 12.9, Italy 12.1, Mexico 10. So actually, food inflation is still relatively high in a lot of countries in the world, even though the World FAO index has started to decline, and started to decline many months ago. In South Africa, we think that the impact of load shedding on the food supply chain is one of the factors keeping food inflation high. If you take ShopRite, Checkers say they're spending 60 million rand a month on diesel. Astral's results this week, they said they spent 781 million rand in 6 months on diesel. These things are likely to be feeding into keeping food prices high. So we don't know precisely, but that's one of the theories that we have.
Prinesh, I saw you grabbing the microphone.
Yes, Governor, I have a couple of questions. If I can pick up my colleague's question about your growth forecasts, please. You mentioned that some private sector economists are seeing growth in the first quarter of 2023 on a quarter-on-quarter basis. What is the number that you see? And then I wanted to confirm that the new QPM will be in effect from July. If so, how much weight should we be attaching to the forecasts that you've given today? You've also spoken in the past about South Africa-specific idiosyncrasies. If you can tell us exactly what you mean by that, and just how much these idiosyncrasies add to your inflation forecasts. That's over and above the 0.5 percentage points you say load shedding is adding. To the inflation forecasts and rates path. I also have a question for Deputy Governor Naidu, because a couple of weeks ago you said that the SARB was nearing the end of the current hiking cycle. A few hours later, that diplomatic row broke out and the rand tanked. Do you now see an end in the cycle? Near. Yeah. That's
okay.
It. Thank you.
Q1, you're so good, Prinesha. We don't have a number. I said that the high frequency indicators seems to suggest that there will be a positive growth figure in the first quarter. We do not have a number. I suppose if we just wait 2 more weeks, we will have the real number from Stats SA. We do not have here. Lovald, you must deal with the new QPM. Fundi, you deal with South Africa's idiosyncrasies. And your question about inflation, I didn't quite hear. Chris, if you had it, you can deal with that. And then a question to DG Naidu, just so that you understand there was unanimity. Let me give it a first step, and then I will give it to him. There is no doubt that we will reach the end of the cycle. When that end of the cycle is a function of the economic outlook of both growth and inflation. You can't keep on going forever, because remember, we are working on something that we call neutral, and we have just indicated we have just gone into tighter territory. The guideline for you should be when you see inflation 10 and you think that this inflation is now going towards the target, then you can safely say, I think now they are reaching the end, or they will be turning. But for now, let me give you to DG Naidu. After the others have got in, he will explain that to you. You want to start? Okay, go.
So let me read from the Business Day article that you've quoted me. Reserve Bank Deputy Governor warned on Thursday of 2 big risks that could put its Monetary Policy Committee off ending the interest rate cycle. The quote is that we think that we could be at the end of the interest rate cycle, but there are 2 risks. The 2 risks are heightened load shedding affecting the inflation outlook and the rand, and the exchange rate. I won't read the rest of the article.
You seem to have answered what Fundi was going to answer, but I'm sure she has got something to add.
Thank you. So on what are the idiosyncratic factors, load shedding is definitely one. The logistics constraints would be the other. A growth rate that is significantly lower than our peers would be on the list. There are other issues that I think investors have made public. I think the most recent in recent weeks has been the Lady R issue that has had concerns about possible secondary sanctions. So in terms of our model, it's very difficult for us to be able to say, well, this much weight goes to that element. So we don't have a number in the same way that we can with load shedding. Because in order to get to a number, you need to be able to proxy something. What is the cost? But overall, I think that these are elements that we think generally undermine confidence or feed into confidence concerns. At a point in time, one does get a sense of what they are. If you look at other leading indicators like what is happening to broader business confidence indicators, if you look at things like the Purchasing Manager Index and those elements that feed into that, but really difficult to put a number to them at the end of the day. But one does see when you look at the country risk premium and you look at South Africa compared to other emerging markets where there is, say, a divergence, because you'll see a moving together in terms of what's happening generally. But when you start to see a divergence there, that's where those elements come in. So let me stop there. That's what we refer to under idiosyncratic factors.
Let me make one comment about the quarterly GDP
Can you
numbers.
put the microphone closer?
Sorry. Let me make one comment about the quarterly GDP numbers. So our forecast has 0.4 for Q1. Obviously, we won't know for certain what the Q1 number is until the quarterly bulletin comes out in a few weeks' time, which is what the governor was referring to. On the QPM, look, there's no material difference between the forecasts that will be produced by the new QPM relative to the one that was used for this meeting. As we tried to explain in the last NPR, we are providing more detailed breakdown in the new QPM on how certain kinds of variables impact on the forecast. So going forward, what we'll be able to do is give you more detail about how some of those other variables impact on the inflation forecast in particular, but also GDP. We will release a paper on the QPM sometime in the next couple of weeks, and we're hoping to use the new model for the July meeting. We've just got to jump through a few hoops to get the paper on the QPM finalized and released to the public. Thanks.
There's one more there at the back. And then, okay, let's take two here and then online. I hope it's journalists, not investors. Thank you.
Two related questions. The first is I wanted to check how you define restrictive. So you say your assumptions show that the neutral rate, as you see it, is 2.4%. So you now have the repo going up to 8.25 and inflation forecast at 6.1. That gives you in the region, but not quite 2.4%. So which inflation rate do you use to define whether you are at restrictive, if you like, and which is the one that we should be looking at to know whether to call policy restrictive or accommodative, if you like? And if I can ask a related question, in a way, do you see a risk that if you over-tighten, if you over-restrict and push the economy into a recession, that in itself could weigh further on the exchange rate and therefore make your task of bringing inflation down more difficult? One economist called it getting into a negative feedback loop. Do you see a risk of a negative feedback loop? Thanks.
Rashad, you're going to deal with Hillary's questions.
Good afternoon. I'm Togozo Kumalo from Newsroom Africa. And it just links to the statement you said that in the long run, the SARB's decision will benefit South Africans. And earlier we were speaking to a trade union that says 65% of South Africans' income goes to servicing debts. And, you know, the rising interest rates actually push them further into poverty faster. And if we're expecting inflation to still continue on the upper band until the third quarter, are we likely to see those rises, and are South Africans really likely to be pushed into poverty before they see those benefits of the interest rates trying to balance off inflation?
Is that it in the room? Thank you. Can we go online?
Governor, we have, I think you've responded to Atul's question, which was on the rand depreciation. Siphelele Dludla from Business Report has a similar question to Hillary's, and he asks, in your words, Governor, you've said you've moved from being accommodative to being restrictive. What can you say? What would you say are the most common implications of these elevated interest rates on people with debt? Are we likely to witness an increase in foreclosure applications as a result?
Is that it?
That's all for now. Thanks.
Okay, Rashad, you can start with that. And then, Fundi, I want you to deal with the issue of whether South Africa could be pushed into recession. And then, no, South Africans would be pushed into even more indebtedness. And the last question, please. The last question, no, the last question will go to DG Naidu.
Thank you very much. So this question of being restrictive is often not a straightforward question, and there are good reasons why. The main reason why it's difficult to pin it down to one particular way of looking at it is that what you want to determine is what is your repo rate against what you think forward-looking inflation expectations are, or sometimes forward-looking forecasts. So if we say that, the current repo rate is 8.25 basis, and your forward-looking forecast for 2023 is 6.2, you're still more or less below what we have as a general rule, that as you go above 2.5%, you're quite restrictive in real terms. But if you look at it against some inflation expectations, or even if you look at it against our forecast for 2024 at 5. If the forecast is 5.1 and your current rate is 8.25, then you're definitely in restrictive territory. So I think that and what do you use, the current repo rate versus the calendar forecast, or versus the actual 1 year from now onwards? So, but I think one mustn't get too fixated with those numbers. But I think that's the general trend: is your repo rate is 8.25, and by a number of measures, if you think that your average inflation rate going forward from here is about, say, 8.5%, then you are in restrictive territory. So I think it's a bit convoluted, but that's the way I think I would describe it. So the thing about does over-tightening have the effect of creating more risk in the rand? I think that monetary policy, before you even look at the rand, monetary policy responding to supply shocks, responding to unanchored expectations, and not too much demand pressures in itself is a risk. The risk is that you have to tighten and slow down the economy much more. But I think that so it is true that when investors look at the risk to the rand, they're concerned about inflation, and they're concerned about the probability of default. Is the economy slowing down more than it should? So in that sense, in theory, you can say that. But I think that what's important for us is to be able to kind of delicately try to measure whether our response is right, so that we think we can bring inflation into the close to the midpoint, but ensure that we don't over tighten to the extent that you kill the economy more than you should, and I think that in itself it can be not good for the rand. So I think it's this is. We ask the public to critically judge. We think we've taken the right decisions. We think that our balance between doing the necessary tightening in an economy that's really come to a halt is a necessary evil to anchor expectations. And I think under those circumstances, we think overall we could be doing a positive for the rand. But that's really the hard challenge we have. Thank you.
Okay. So let me see if I can tackle the question that's been asked about the impact of the decision on indebted South Africans. I think important to stress that as a first principle, the decision that the SARB is taking is to maintain price stability. And of course, it is important for us to keep in mind that maintaining the value of the currency in your pocket, in your hand, is the paramount issue here. So the decision that we take also has an impact on both savers and borrowers in the economy. And I think most of the time we pay attention to the impact on the borrowers, but also important to keep in mind that we do want to preserve the value of the funds of those that have savings in their bank accounts as well. So regarding the impact of borrowers, we have done work as a SARB a while ago, also looking at who borrows in general. We remain of the view that if one looks at the very poor in South Africa, most of those people actually are not borrowing actively in debt markets. But what we have seen is that where there is borrowing, the biggest impact on borrowers is not necessarily the decision of the MPC, but how the lenders, the banks themselves, perceive the risk of lending to those individuals. But as part of the decision that we take, yes, we acknowledge there is an impact. When you borrow, the cost of borrowing has gone up, but it is part of that longer term objective of signaling to all of us that things are a bit tighter in the economy. The cost of borrowing is more expensive now. Slow down a little bit, because this is part of what has to happen to signal that pricing must come down and inflation must come down over time. The governor highlighted earlier that yes, there is short-term pain. So the short-term pain does hit us in terms of borrowing, of course, but it is with the longer-term objective of preserving the purchasing power of your rand and my rand at the end of the day. And that's how we think about things, and we balance the effects of our decision as the Reserve Bank. Kuben, are you answering next?
Chair, I think they've been covered.
Okay, thank you very much. Well, I got told that I rounded the room and I said those were the last questions in the room, and I had to go online. But since you have not asked any single question today, let's just go to you.
Hi, Governor. Alex Winning from Reuters. In the wake of the decision, the rand has hit a new all-time low. It's down about 2% against the dollar.
To the mic so that we can hear your question.
Sorry, in the wake of the today's decision, the rand has hit a new all-time low. It's down around 2% against the dollar, which suggests that some traders think that a more aggressive hike was needed to control inflation. You mentioned your decision was unanimous today, but was 75 basis points considered? And yeah, what do you think about the rand slumping in the wake of the decision? Thank you.
Okay, Prinesha, you'll have to accept that that was the last one. The steps we take on the interest rate front might have an effect on the foreign exchange market. But we do not adjust our policy stance to deal with the exchange rate. We adjust our policy stance to deal with the effects of the exchange rate on inflation. So we are responding to inflation and not to the exchange rate. Was 75 basis points discussed? Yes, it was. So was 50. So was 25. And so was 0. So we considered all of these things. And based on the information, the data that we have, we came to the conclusion that the correct decision to go with is 50 basis points. That's what we had dealt with. That's why we will run up, because we are closing. Just on this over-tightening thing, economic history is a teacher. And we do know from economic history that the failure of central banks to tackle inflation timeously results in a situation where the central banks then have to act even more aggressively to try and tame inflation and cause actually far more lasting damage to the economy. Such is the lesson from what we had seen with stagflation in the 70s and 80s. That is the lesson. If you under-tighten and you get found to have been wrong The markets do not trust you. The price setters do not trust you. And to earn your stripes, you're going to have to be more aggressive. And that comes at massive costs. It's a lesson central bankers have learned. However, if for some reason you discover that you have over-tightened, the correction is so swift because you will just cut. But by that time, if you have over-tightened, inflation would be lower. Everybody will be benefiting from that. So correcting yourself is much easier. It's far, far more difficult and costly to correct yourself if you have under-responded. So, put simply, DG Kasim said that this might be a necessary evil. That's one thing. But we have got a sick economy. It's suffering from inflation. We have got to take the medication. The medication might be bitter, but if the patient does not take the medication, they will end up in surgery and in intensive care. And our task as the South African Reserve Bank, acting in accordance with our mandate that says we must preserve price stability in the interest of balanced and sustainable growth, have had to deal with this challenge. An earlier question was asked about the tools and what other things can be done to tackle with inflation. We had mentioned that there are things in this economy that could be done, but so by other agents of government to make sure that we arrest the surge in inflation. Failure to act against inflation would mean that we are shortchanging the poor, we are shortchanging the working people of this country who are constantly crying about inflation eroding their incomes. And a central bank worth its salt have got to act to protect those incomes. And in the acting to protect those incomes, we've got to administer this bitter medicine which will avoid surgery or being in the intensive care unit. And so that is what central banks are there for. And we believe that we have taken a step that is appropriate for the conditions that we actually face. Thank you very much. That concludes the proceedings of today.